This is the Future Talk, ESG, credit ratings, and the cost of capital in the Global South. Please welcome to the stage Allison, Holland, from the International Monetary Fund.
So welcome, everybody. I'm very glad to see so many of you here for one of the final sessions of this wonderful conference. So one of the key themes that we've explored over the last day or so is the need for the developing world to access sufficient financing to support sustainable development. And indeed, at the IMF, we see the question as to whether developing economies can access sufficient financing on terms compatible with maintaining debt sustainability as one of the key debt challenges of this moment. And we share the concern voiced by many over the last day or so that the cost of servicing this debt is crowding out countries' capacity to invest in development. So international capital is so critical at the current conjuncture. It is seen as a real way to substitute for the potential drop in ODA that we've heard reported. But it is the cost of that capital that is one of the biggest concerns for us all today. So you may recall what Mo Ibrahim said at yesterday's opening session, that if developing countries want to attract good capital, there is work to be done on governance and security. So two key foundations of sustainability and indeed two key foundations of this concept of ESG. So what is ESG? ESG is the framework of environmental, social, and governance factors that can contribute meaningfully to sustainable development. So a country with strong ESG metrics would generally be expected to have a lower risk of default because its economy is more resilient, its workforce is healthy and educated, and its political institutions are stable. So aligning very much with the emphasis that Mo flagged yesterday. So to help me explore the interrelationship between ESG and the cost of capital, I have a great panel with me today. So let me start by introducing María Ibáñez. She is the Vice President for Sectors and Knowledge at the Inter-American Development Bank. And with her, yes, please, a great round of applause, thank you. We also have Matt Robinson, who's joining us today from Moody's Ratings, where he's an executive director. We are also joined by Mavis Owusu-Gyamfi, who's the president and CEO of the African Center for Economic Transformation, so one of Africa's leading economic policy institutes. And finally, and with our great thanks, I'd like to introduce Stephanie Bilo, who's the Chief Client and Investment Solutions Officer for Responsibility Investments, so one of the active impact investors represented here. So we have 41 minutes for what will hopefully be quite a dynamic discussion. So to kick us off, can I ask each one of you how you think sustainable development and creditworthiness complement each other? Is there a trade-off to be made here? So let me have 1 minute for each of you, and let me start with María.
Thank you very much, Allison. And indeed, they complement each other. We do believe this at the Inter-American Development Bank. Investments in sustainable development strengthen the foundations of sovereign credit worthiness. Why? Because it improves long-term economic growth. It also improves fiscal resilience and institutional effectiveness and the capacity, and this is very important, to absorb shocks. And this is particularly relevant when we look at Latin America and the Caribbean, where countries often face challenges having access to low cost and long-term affordable capital to invest in the many priorities of our region while also maintaining their debt burdens and, in addition, the high fiscal pressures that the countries are facing right now. So we do believe this is important, it's complementary, and we believe also that IDB is part of the solution by helping countries in all this process.
Great. Thank you very much. Matt, your views?
Yeah, I think that's absolutely right. Agree entirely. From a credit perspective, it can sometimes seem like a trade-off. You think investing in resilience, adaptation, mitigation it's not cheap. Those that need it most are often the ones with the least capacity to spend. They're lower-rated sovereigns usually facing liquidity challenges, and waiting for the longer-term benefits from that investment is hard because you can't pay a coupon with a longer-term benefit. You need money here and now. But it's definitely complementary because securing the future is what leads to your debt service capacity. Avoiding future costs is what demonstrates your ability as a government to be forward-thinking, understand what is needed here and now. It's a multi-year, multi-administration approach that engenders confidence amongst the investor community, allows them to borrow at affordable costs. So two sovereigns, one focused on this, it's definitely a complement.
Fantastic. So Mavis, your perspective from Africa.
So the answer is yes. And just building on what my colleagues have said, the first one is that environmental risks affect long-term economic sustainability and growth. So if a country is exposed to droughts, if it's exposed to flooding like my country is right now, there's a high cost to it. So the infrastructure damage that governments have to reinvest in, the loss of agricultural productivity, you cannot separate the two. And then your social factors also affect it. So if we think about, political instability, if we think about productivity, you really can't separate those from your investment and growth. If you don't have policy credibility, if you don't have fiscal discipline, it doesn't work. But underpinning all of this is what we feel is most important, which is resilience. Okay, we need to build economies that are resilient to shocks. We live in a very uncertain world right now. So for me, even the fact that we are asking the question is problematic. It should be part of what we do every day.
Fantastic. Stephanie, you have the last word on this.
Thank you. I would very much echo the last statement, because we need to stop treating this as something else, something complementary. At the end of the day, sustainability is a credit issue. And if we fail to address this early on, the costs are so much higher for the economy, for the country. So in terms of building resilience, this is much cheaper done at the outset to prepare adaptation, have policy there, as opposed to then treating the droughts and the floods. And I think that's very much where we are coming from. This is a condition sine qua non.
So maybe actually I can pick up on what you just said, Stephanie, and maybe we can go on to explore a little bit, in your role as an impact investor. You said that you work directly with the private sector, but of course you cannot ignore the country context and the overall resilience of the countries you're looking to operate in. So can you say a little bit more about how a country's ESG, or more broadly, how a country's resilience translates into your appetite to provide capital?
So we at Responsibility, we invest into over 70 countries across the globe. And that's really Latin America, Africa, and also Asia. It's really emerging and frontier countries, which we tap into, which we often are one of the first bilateral investors in some of the companies. So just to be clear, we do not take sovereign risk. We always invest into the private sector in those economies. Nevertheless, there's a lot of factors that come into play with regard to assessing, can we go into this country and invest? And I mean, the IMF has shown a very nice study recently. It's very clear that governance plays a super important role in this field. And funny enough, from our perspective, is a bit strange that environmental factors play a much less role with regard to the credit spreads and the factoring in. We do see quite often actually the other way around. Let's just pick an example like Vietnam. By having a strong economic policy where they see electricity demand will double by 2030, there's also a very strong power generation plan behind it to build this, because that's how you can attract manufacturing, that's why you can continue export, and that's how you can basically create more decent jobs. So you see that there's a direct link from strong environmental policy that is not set out to say we're going to do more solar, but it's really like we want to give energy security to those companies and have an efficient grid and have actually the ability to those companies that they can produce. And that translates from company growth to having more exports, having tax revenues increase, and directly translating also to strong policy. So environment to credit spread.
Wonderful. So maybe, Ana María, you mentioned some of the challenges facing the Latin American and Caribbean region that you work in. So across your membership, what have you seen as the most impactful improvement in ESG or sustainability in terms of improving access to financing?
Yes, so let me first go a step back to provide a little bit more of evidence of why this is important. For example, in the Caribbean, when a disaster strikes, a hurricane strikes, the impact on GDP growth can be between 2 to 4%. And the increase in debt during the following 3 years is going to be around 18%. So yes, investing in resilience is important for long-term sustainability of the country in terms of debt, but economic growth as well. We also know that when countries and face improve in ESG factors, they are associated with much lower sovereign spreads. So what are we doing at the IDB? We are doing several things, but I just want to mention two, Allison, that I believe are important. Basically, we're trying to innovate such that development outcomes and long-term debt sustainability, financial soundness come together at the same time. The first one is that we are working with instruments that combine lower cost market access, credible commitments to sustainable investment and better governance. These credit enhancements tools, such as the sovereign guarantees for debt for sustainability conversions, allow countries to access financing on much better terms, lower cost for these credits than their standalone credit profile will allow. And it uses our balance sheet, and it leverages our balance sheet, which is important. There is something that I also believe is very important from these transactions, is that it forces the countries to deliver better governance, development outcomes that translates really into an environment that is not only important for that particular transaction, but for other transactions in the future. For the particular transaction, it is important because it improves debt management. And that's something that I believe is important. It provides also development outcomes for the country, depending on the topic of the debt conversion. It can be either public health, restoration, and resilience. We have done debt conversions for all of those. And we have the trust funds that support the underlying commitments. And that is also creating better governance for the country. On the ESG side, which I do believe it is also important to mention, we have the environmental and social safeguards policy that we approved in 2021. We used to have another one, but we strengthened the new one. And this improves ESG in two channels for the country. The first one, the direct one, the immediate impact, which is because each of the projects that we fund are required to abide by the standards of our ESG policy framework. So immediately, the standards are higher, and this is very important. And we have standards for biodiversity, for local pollution, for resettlement, for stakeholder engagement, for resilience, and many other topics. But the second and the most, I would say the most important one is that we build capacity in the countries in which we are operating. We fund the countries, but the countries are the ones who are executing the projects. So they are the ones who need to fulfill the requirements, the ESG requirements. And this implies that we are embedding into the executing agencies, the ministries or any agency that is executing the project, all these ESG standards, such as environmental risk assessment, the stakeholder engagement, and grievance mechanisms, among others. And this remains embedded within the ministry.
Great. So I think we've heard a lot about the virtuous cycle now between resilience, policy, capacity development, and how it can all sort of, translate into better outcomes for the countries and better access to financing. Mavis, we do hear a lot about what, this African risk premium, and, as something that keeps the cost of capital high. So what do you see as perhaps the biggest challenge for African countries in terms of addressing that perception risk? And what is it that countries need to do? And is there anything that in the international financing ecosystem that needs to change?
Okay, thank you. So for us, the central challenge we're trying to solve here is the gap between perceived risk and actual risk. So at Asset, we do a lot of work on credit ratings with a number of national governments. And, analysis that we've done, that others have done also shows that actually the perceived risk is much higher than the actual risk. So a study by Africa No Filter showed that negative news headlines alone cost the African continent 4.2 billion every year. Okay. And work that Asset did with OECD, citing Moody's own project finance, has shown that African infrastructure debt performed much better than perceived. So between 1983 and 2017, Africa project finance loans recorded a 5.5% default rate. It was the lowest in the world. The next lowest was actually Western Europe at 5.9%. And it went all the way to it goes all the way up to 12.9% in Latin America. But, often where we sit, we always say to our governments, what's on your doorstep that you can fix yourself? Because we can ask people to fix things, but let's see what we can do. So I would like to outline 5 practices that we are practically doing with government on the continent right now. The first one is we're encouraging them to build a dedicated unit in ministries of finance that will work with credit rating agencies. So rating engagement shouldn't be this one-year rush by thing. We should really have units that have relationship management that engages these agencies and investors consistently throughout the year. And this is because from a lot of the conversations we've had with rating agencies, 90% of variation in ratings is driven by a defined set of quantitative variables. Now, if you know which levers to move, you can be more proactive. If you don't know which levers to move, what tends to happen is the rating comes out and you get upset. Secondly, we need to fix the data deficit. So the big 3, as they are famously known, use a lot of data-driven methodologies, and they often rely, to be honest, on limited data when they're working in Africa. So when the data is thin, of course, the subjective judgment plays out a lot higher than it should. So we're really encouraging governments to look at data and be ready to share data on progress on things like economic transformation, etc. And if you can provide timely, granular data, you are in the game. If you can't, then don't be upset. Thirdly, have a strong narrative. Narrative is really important. Now, when we looked at a number of countries, we looked at Tokyo, we looked at Brazil, and when you go there, they don't just hand over a set of data, they have stories and narrative around the data. So we are encouraging governments get ready with your data and your narrative. If your data is about job creation, if it's about growth in specific sectors, it's about returns on investments from large companies, be ready to share it with that data. And government must also understand what investors prioritize. Not all we have this kind of blanket approach to investors, and investors are really different. For some investors, it's about repatriation of profits. For others, it's about reliable electricity. Be ready with that information for the right investor to be able to do it. 4, be ready to challenge credit rating agencies. Now, sorry, between 2011 and 2024, there were 29 statements from 12 African countries disputing rating decisions, which tells you that the grievance is real. Let's be honest, there aren't many countries being rated by the big 3 on the continent. So if 12 are raising 29 grievances, there's a problem. But what we tend to do as countries, we have these scattered narratives. We need to be more structured, more focused. The ratings process should be one of engagement. Governments need strong narratives, but they also need the ability to challenge with evidence and robustness. Ministries of Finance are engaged in deep technical discussions with rating agencies when you turn up in Berlin. But we don't have the same on our continent. We need to turn that around. And finally, use the media wisely, okay? Now, if negative news is costing us 4.2 billion per annum, we need to have a clear communication framework around our fiscal policy. We need to talk to the media with discipline and technical proficiency. We need a clear communication strategy, and we need a clear communication narrative. You can't have the Ministry of Finance saying it's left and the Ministry of Foreign Affairs saying it's right. Doesn't work. So keep the official narrative consistent and make sure that you influence public policy. And that's why at Asset, we invest in training the media right now around how they communicate on what the credit rating agencies put out, how they communicate on it to investors, just so that the narrative that countries are sending out and the region is sending out is consistent. And that includes a war in a demonstration in Kenya is not a demonstration in Ghana. They are miles apart.
Yeah. So I think that's an excellent transition, I think, to Matt. So Matt, we've just heard, that there are many complaints, I think, about the credit rating process. And I think Mavis has outlined some very important elements of advice to countries on how to address the credit rating process. From your perspective, what are really the 3, say, key factors that countries should focus on if they want to improve their credit ratings?
Yeah, look, I think what Mavis says is fair. I do genuinely believe that better data helps us do our job better. And we welcome the scrutiny. We're not infallible. We're not standing here saying our opinion is always right. We like being subjected to the same scrutiny that we subject the issuers to when we go there and we ask really tough questions. And I think it's incumbent on us to be as transparent as we can be. May not agree with the outcome or our explanation, but at least we're transparent in why we've taken the decisions that we have. And at the end of the day, ours is just one opinion in the marketplace that investors base their decision on. And I think it's genuine that there is this issue of an Africa premium in so much that it's not explained by credit. We give the same rating to an African sovereign, B2, as a Latin American sovereign, B2. The African sovereign pays more when they go to market. Why is that? Well, it's not credit, because I've just told you it's the same default risk. Mm-hmm. So it's not a credit issue. It's something else that's going on. Maybe it's a liquidity in the market issue. Maybe it's a reputational issue. Maybe it's a communication issue. As you said, some of the best sovereigns in the Africa space are those that have issued multiple times because they've built up that relationship. They've got the narrative. Maybe they needed help and assistance, a guarantee the first time, but the second time they didn't. The third time, they're pricing inside some of the other sovereigns at the same rating level because they've got that story to tell and they've brought that to the market. What are the 3 most important things? Well, look, I think governance, without doubt, is important. Fiscal policy, of course, and being able to deal with event risks. And I think all three of those come back to this point about sustainability, that a government that is investing for the future is demonstrating good governance. They're avoiding the fiscal costs in future that will ultimately otherwise detract from their debt service capacity. And they're preventing, or to the extent that they can, limiting the likelihood of events coming and striking them in a way that undermines their debt service capacity. We're getting better as a credit rating agency in articulating E, S, and G in our ratings. They've always been there. Governance is a fundamental pillar of our sovereign methodology, but we're getting better at articulating how is environmental risk being captured, or how is the social pressures and what's being done about it leading to our credit rating actions. We have seen just recently a downgrade of Mexico that was for a number of reasons, including water stress, where we cited what's going on and the stress that's delivering to the future livelihood in Mexico. That was a key issue. But equally, it can be in reverse. Governance can be something that fortifies a sovereign against a downgrade, or indeed, good governance can actually lead to an upgrade. One of the examples that I do like to talk about is the Jamaica catastrophe bond when Hurricane Melissa struck. We already had Jamaica on positive outlook. We'd recognised a good decade of fiscal consolidation. A lot of good governance was in place. Suddenly hit by a hurricane. This cost the equivalent of 40% of GDP. Yields spiked. Investors were worried. They said, "Is this going to lead to not just a downgrade? Is it going to lead to a default?" A couple of weeks later, we still upgraded Jamaica. Why? Because they demonstrated really good governance, really good foresight. The cat bond came in at precisely the time they needed it, meant $650 million worth of relief that they didn't have to go out and borrow in the market at the higher rate. So it prevented the crystallization of that higher cost immediately on their fiscal balance sheet. We upgraded. Some investors were saying, "Why are you upgrading in the face of this?" Was good governance, really good governance. Maybe I don't know if I've got any time, but maybe governance is such a critical issue, and in some respects it can be subjective. I know the challenge, particularly when we're in a European environment or in the US environment, talking about how governance. A lot of people associate that with politics of the day, and it's true that the politics of the day, the politics of certain administrations can be eroding governance over time. We take a lot of confidence from the core institutions when you're talking about the strength of civil society, talking about the quality of the legislature. You talk about the fiscal policy, the macroeconomic and monetary policy arms of the government that tend to be able to outlive an individual administration. But we do see it, and we do take it into account. And certainly what we have stated publicly when we downgraded the US to AA1, and we said what could lead to a further downgrade is this erosion of institutional capacity. We're not ignorant to it happening, but we still take a lot of confidence in the very strong core institutions in the US. Now that means, I'll stop at this point, that means that governance takes time to erode. It also takes time to demonstrate. Jamaica was a really good example that took time. The African governments that I deal with when I'm in country, I see the changes over time, but this is, I don't want to call it a generational thing. It does take years, though, to change, to implement reforms, to be able to provide a conducive regulatory environment, to be able to generate an operating environment where businesses are happy, bring foreign direct investment into the country. That's a long-term issue. And the more that we see governments committing multiple year strategies over multiple administrations, the more we see that, the more confidence we get.
Great. I think that's all fantastic. So I want to do one more final round, and we've heard a lot about the importance of governance, the importance of investing in resilience. We've heard a lot about the importance of narrative, engagement, being forward-thinking, and really kind of getting some core basics right. So I want to hear from each of you. If you could pick one low-hanging fruit, what is one low-hanging fruit that countries could do that would make a meaningful impact on their cost of capital or their access to capital? Ana María.
Thank you, Allison. In Latin America, the Caribbean governments are working very hard for improving the sustainable financial architecture. And I was going to provide the example of Jamaica because it's a great example. No? They had insurance for the different layers of risk, not only the cat bond. They had fiscal consolidation, the cat bond, plus other instruments that were very important. But a low-hanging fruit, I already mentioned it, Allison, and I'm going to mention it again, which are the debt conversions. We do believe this can be important. At the IDB, we have been working with governments on that. We provided 690 million in sovereign guarantees and mobilized more than 2 billion in the last 3 to 4 years. We did it in Barbados, Bahamas, and Ecuador. And these have already demonstrated a transformative potential for this approach. There is something that is very important and innovative in this is the sovereign guarantee that the IDB is providing. And as I mentioned already, we are leveraging our balance sheet for that. In these guarantees, what we do is that we refinance part of the debt of the country at lower costs, and the country then redirects the fiscal savings and the savings for the debt payment for funding development outcomes, development goals, and development programs. And this is important. This frees up fiscal space, which in Latin America is very important. We are facing very tight fiscal conditions, and countries therefore gain the ability to invest this in development priorities without adding to the debt ceiling. So this is important. Another factor is bringing the right incentive structure. So what we do with this debt conversions is that the commitments are embedded into the debt for sustainability conversions. And this is critical for the governments to deliver on the policies such that they get access to these funds and the reforms that should address the sustainability goals that they defined from the outset. And these commitments guide the fiscal savings that the country is receiving. In the case for debt for nature conversion, we made debt for conversion for marine protection, ecosystems, for restoration programs. But something that is crucial is that it included KPIs that the government needed to monitor and deliver results on it. And again, this builds governance, which I believe is part of a co-benefit of doing all this. So this, we believe, is a very good low-hanging fruit from our point of view.
Thank you very much. So Matt, you spent quite a bit of time talking already about governance. Is that your low-hanging fruit?
Well, yes. Well, for a start, it's not for a rating agency to prescribe what a government should do. Governments are accountable to their people. Do what your people want you to do. We can't prescribe it. But the low-hanging fruit is getting good governance in place, delivering on the policy reforms, making sure the conducive environment is there, and communicating that to the investor community. We're but one means to do that. And I'd like to think that credit ratings make a difference in investment decisions of the pension funds. But to be honest, it's the pension funds seeing what the governments are doing. Mm-hmm. Good policy leads to good outcomes. Good outcomes lead to good creditworthiness. The ratings follow the good outcomes. It's not do something for the sake of getting a good rating. It's do it because investors value that. And that's what we'll reflect in our ratings.
So Mavis, I think that was very much aligned with what you heard or what you shared with us earlier. Is there anything particularly that you want to emphasize?
So just very quickly, before I come to my point. It's become a bit of a joke that when we meet with our credit rating agency partners, we poke them. But I want to put it here right now. They have been great allies in the work that we're doing with African countries right now. So the big three have worked with ASET, UNDP, Africatalyst, and the others around helping us to understand. So I just want to put that on record, but I will keep poking him because Matt knows that that's what we do on stage. But yes, I agree what has been said. Look, building strong, credible, and predictable institutions that make sustainable policies and public finances trustworthy is what countries need to do. There's no such low-hanging fruit. And to be honest, it's important, if I may, for 4 reasons. The first one is that the dominant barrier to finance today is actually country and policy risk. It's not a shortage of capital out there. So we've got to fix that problem. Secondly, investors are pricing their capitals based on a mixture of perceived risks of policy reversals, regulatory uncertainty, contract enforcement, and macroeconomic instability. So whether it's perceived or not, if you're not showing progress, you are not going to change that direction of travel. So having kind of credible climate strategies, sustainable strategies are really, really important. And regular public reporting. We never talk enough about regular public reporting on transparency. Thirdly, it will enable us to access cheaper financing. We can do a lot of things, but if we don't get these systems in place, we will not be able to access cheaper financing. And finally, to be honest, it aligns incentives. So a predictable framework channels capital towards sustainable outcomes rather than short and brown investments. Yeah. So there's no low-hanging fruit. It's about rolling up your sleeve and getting on with the hard work.
So I'm really glad you mentioned the issue of debt transparency and public reporting. We had a very interesting discussion yesterday on just that issue. So again, it all plays into the whole narrative story, the whole getting the basics right, but really glad that you raised that. So finally, Stephanie, as the woman with some of the money, and we just heard from Mavis that there's plenty of money out there. It's just a question of how countries, how good ideas can access that capital. So what, in your view, is the one thing you would advise countries to do?
This is a very hard last statement to make because the main things have really been said. And, this is all about building a credible economic strategy, and that needs reporting on outcomes, continuous engagement, and also us as impact investors. We are really not looking for the next sustainability report, but it needs to be a credible policy that fits the country. Having said that, we need to fix one thing that's not what we can do in this room. We need to fix the perception of emerging markets. We don't have a capital problem. We have an allocation problem. So this is what we need to be working on with global capital markets, with global investors.
I think that's a great way to kind of end our discussion today. It's been a really dynamic discussion. I want to say thank you to all my great panelists. So I'd ask you to give them all a great round of applause. And I think we're kind of pretty much bang on time. So I would encourage you that we have one final session of the conference, and this is the wrap-up session, which will begin at 5:30 downstairs in the Alliance, the new Alliances talk area. But I think with this, I think there's plenty of food for thought. I think we can, basically it's about rolling up our sleeves and getting the hard work done. But there is optimism, there is hope. And so I think we should all travel optimistically from today. Thank you very much.